thank you so much for joining us on ET Now. We're at the fag end of the earnings season. It has largely been in line with what the street was working with, although the outlook for the second half of the year, basis the conversations that we have had with the managements, continues to remain very positive. Your thoughts on the earnings season and how the fundamental market setup is looking like?
Good morning. As far as second quarterly earnings season is concerned, clearly it's been more or less in line with expectations, one could say that. Although the expectations were quite muted to begin with, the delivery has also been broadly in line with those muted expectations. And that's what is also keeping markets at around current levels, I would say. However, as you also mentioned, the commentary from most management seem to be turning a little positive. And we do expect that the GST Rejig and good monsoon will start to lead demand recovery in the country. And that should aid second half earnings. And sequentially, we are expecting earnings to improve from here on well into 2027 financial year as well. So to that extent, I would say probably we are seeing one of the worst downgrade momentum that we had seen on the earnings for quite some time. Probably it seems to be stabilizing at this point of time, and we should be able to see some stability as well as some recovery in terms of the earnings growth going forward.
Harsha, hi, morning. This is Harsha. Plenty of moving parts with regard to Indian macros, and the government has pushed out plenty in terms of regulatory stimulus. But talk to us about the two key factors which the government is attempting to drive: consumption and CapEx. Expect that to turn around, and if so, how quickly?
Harsh, if you look at CapEx for the first 5 months of this financial year, clearly it's been at around 45% year-on-year growth, but one should not extrapolate that going forward. This was because of the low base that we had seen post-elections when CapEx numbers had really seen a downturn. And on that basis, we have seen some front-ending of expenditure this year, and we have seen about 40-odd% growth on a year-on-year basis. However, we can expect probably a low double digits kind of year-on-year growth for the full year, which is not bad. It may disappoint some of the market participants given the fact that we were growing at even higher pace in the past. But given the fact that we have to keep an eye on fiscal deficit and our nominal GDP growth is somewhere around that double-digit mark in terms of expectations, we can't be really expecting too high a CapEx number on a year-on-year basis. But whether it is 10% or 12%, I think it's a decent growth over the previous year, and we should continue to see that kind of incremental addition as well going forward. That's on the capital expenditure part. As far as consumption recovery is concerned, we do hope that the GST Rejig that we have seen is a long-term structural positive, and it increases affordability for most of the population. And there are many categories where we have seen 8 to 10% kind of price declines because of the Rejig, which is a huge boost to consumption, I would say. And on top of that, we have had rain gods smiling at us second time in succession, where this year's monsoon has been about 8% higher than long-term average, and reservoir levels are also high, which means that, God forbid, the next monsoon season is going to be below normal. Even in that case, the agricultural output next year, because of the reservoir levels and the confidence that's been there for the previous 2 years, should continue to be quite high. So overall, I think consumption is also looking up at this point of time. However, the recovery is not going to be V-shaped. It's going to be gradual. And that's what we are expecting in terms of earnings growth as well.
Harsha, Sajid here. You spoke about the capex cycle. How do you look at some of the capital goods companies? I mean, numbers haven't been impressive in this quarter. Many of them having issues with respect to the industrial segment. Thermax, we saw having a bad number, bad quarter specifically.
Sajid, I think you need to be selective in the industrial space as well, just like most other sectors of the economy. I think as markets have been trading at fair range of valuations or slightly higher than fair range of valuations, you can't really expect any segment to be available at very, very attractive valuation levels. And as we have noticed, the delivery in industrial space is also not going to be linear. Quarter on quarter, it's very difficult to predict some of the business momentum or the margin profile. So to that extent, one needs to be a little bit more long-term focused, and also have to be very conscious of the valuations that you pay for some of these businesses, and take a selective approach. And that's what we have been doing in our portfolios. At one point of time, post COVID, we had very large overweight on industrials. But if you look across portfolios now, that overweight stance has either changed to neutral or slightly underweight at this point of time. We are playing some of these businesses more on a bottom-up basis, wherever we have comfort on growth as well as valuations, rather than playing the entire sector.
And in the auto space, Harsha, I mean, you spoke about consumption. Two-wheelers and passenger vehicles are, depicting a different story actually.
You're right. The volume growth in two-wheelers seems to be a little more positive compared to four-wheelers. The festive season has panned out the way we expected. It's been a very strong festive season. Part of it was also because of the fact that there was a deferment from middle of August until about September 22nd. And that also coincided with the festive season later on, and hence we have seen very strong volumes for both two-wheelers and four-wheelers. Now there seems to be a little bit of a slowdown in the very, very short term. However, we need to watch this piece and see how in the wedding season the two-wheeler and the four-wheeler space pans out in terms of the volume growth. Overall, from a 2 to 3 year perspective, we do believe that it's a good space to be in. But however, given the fact that there has been a sharp rally just around the GST announcement and thereafter, there could be some consolidation in some of the stocks. So to that extent, one should not really chase the momentum. However, if you're a long-term investor, I think this is a segment that you need to be.
Also, capital market space, only one exchange listed, BSE coming out with good set of numbers, but on the brokerage side, we have seen some sluggish growth coming in, and we have one of the discount brokers also listing on the stock exchanges.
Sajid, clearly capital market space is one where the penetration levels are very low in terms of how many customers actually are on some of these platforms, how many of them are actually trading or investing into capital markets. So to that extent, I think there is a very, very long way of a long runway for growth. However, again, this segment has done exceedingly well in terms of the stock market performance as well over the previous several quarters. So to that extent, you need to be little cautious in terms of selecting stocks at right valuations. However, from a longer term perspective, I think the opportunity is very large. One can definitely bet on capital market intermediaries in that sense.
Harsha, any tactical play at this point? We're closer to all-time highs now, trying to get a sense over the next maybe quarter or two. Any tactical plays? And I know you can't talk stocks, but maybe sectors which are tactically bullish on.
Generally, we do not attempt to have too many tactical allocations in our portfolios. However, from a very short-term perspective, clearly there seems to be some momentum in global commodities, especially metals, and we do believe that if some of the Chinese capacities go out of a market, then the strength that we have seen in pricing can continue for some more time. So tactically, one may look at adding some of those metal names.
Right, so positive view coming in on metals, but also wanted your thoughts on the banking sector as a whole. Last time when we interacted with you, you did tell us that we've seen some kind of consolidation in the sector and that perhaps earnings could inch higher in the next few quarters. Basis the kind of earnings the sector has reported in the second quarter, what will your now view be on the sector as a whole?
Clearly, we were a little surprised to see net interest margins kind of holding up for the sector as a whole, despite the fact that we have seen repo rate cuts successively over the last few quarters. Going forward, we are not expecting too many interest rate cuts. So to that extent, the pressure on net interest margins should not be too high. And at the same time, we do expect credit growth to inch up slightly to higher levels. So overall, we do believe that in financial year 27, for example, this is one segment which will grow much higher than the average market earnings growth. And the sector has also consolidated quite nicely over the last couple of years. So overall, I think this is going to be a sector to really bet on if you are looking at financial year 27.
Okay. Mr. Upadhyaya, great speaking with you. Always great getting perspective. The calm and composed voice in all of the storms that come our way. Thanks for coming in and speaking with us.